Taylor Swift out with a new album announcement. How does that relate to commercial real estate and multifamily? Well, it may not, and that's a good thing because we've got three important topics to talk about today on the Gray Report. First, CPI print came in a little bit softer, a complete relief to many commercial real estate borrowers. We know you guys have those bridge loans that are kicking the can down the road. Core came in a little bit hot, but I think we're all going to breathe a little bit easier tonight. Also, we're talking about Fannie and Freddie being privatized, but actually maybe going towards an IPO at the end of this year. What does that mean? Are we going to be paying higher rates? And what's going to happen to that guarantee? Finally, we're going to do an update to stress, delinquencies, loan maturities in the commercial real estate market, multifamily, also some capital markets activity from Newmark. I'm going to stick around for the entire episode of the Gray Report. Stick around. Let's get into it. Welcome back to the Gray Report. My name is Spencer Gray, president of Gray Capital, and I'm joined once again Director of Communications and Marketing here at Gray Capital, Dr. Matt Bosnagel. Matt, how are we doing today?
Pretty good.
Matt, CPI came out. Fortunately, it was this morning. We have time to look through it. Maybe we've got a deal going on. Maybe we're trying to lock some interest rates. So maybe I was paying a little bit closer attention than some of them. I pay pretty close attention to all the CPI prints because we typically do see rates move around the announcement. A little bit of relief. Yep. Inflation is not as hot as some people were fearing, thinking that tariffs are going to really seep into the system. There's a little bit of evidence of that, but it looks like the biggest driver of inflation is shelter and housing, which we know is a little bit weaker than the CPI is actually printing. So, the index came at 2.7, anticipated was 2.8. Core, though, increased from 2.9 to 3.1. So cooking a little bit hotter, but it's not a worst case scenario. Yep. We're kind of almost in this Goldilocks zone because we're all anticipating potential rate cuts later on in the year by the Federal Reserve. I think the probability now is 85% for there to be 2 rate cuts in 2025. And this CPI report set it up for that to be a possibility. We've got a Jackson Hole speech in 10 days. Yep. They're going to give us a little bit of insight and kind of that nuanced opinion of what they're thinking. What was your reaction to the CPI report, Matt?
I think it was a little bit boring. I think it was essentially flat, maybe a little higher, a little lower. I wrote down, I was writing here, you can find your own worldview supported in these numbers if you want. If you're looking and you want to cherry pick something that seems like inflation's going down, then you can find that in there. If you want to find areas that are going up, like there's used cars, household furnishing, medical care. Those are some of the categories of price increases. You could say, used cars, well, it's because of those tariffs. Or
the used car tariffs?
Well, the used cars are making the imports that are expensive, and then the used cars it's a trickle down tariff pricing effect, I think. But if you're willing to make that, I think that there has not been any kind of dramatic price increases related to tariffs.
Are you thinking we're going to still see that? I mean, you would think that there would be some. It would show up maybe a little bit more, but we're just not seeing evidence of it.
Yeah, I'm completely unsure right now. I think that I don't even know how much tariffs are being paid right now, or if they are going to be, or if they're delayed. Like, it just seems like what it's done is create uncertainty, and it hasn't necessarily had an impact yet on imports. We're still waiting. I think those headlines, you were mentioning some headlines that were like, this is it, that proves it, that's tariffs are inflating prices, that's it, this is it. But,
the New York Times, the headline was, tariffs finally show up in the CPI report, the hot CPI report, and then core inflation is up 3.1%, the highest reading we've seen in 5 months.
Yeah.
I'm like, 5 months?
Yeah.
5 months? I was like, so then year over year, it was higher under Biden. And I'm completely ignoring, you're going to highlight whichever statistic kind of fits your narrative. And not a fan of tariffs. I think we would have less inflation if there weren't tariffs.
Yeah.
Now, but there's also the cool down effect from the uncertainty of tariffs that happened also.
Yeah,
so there's all these counterbalancing forces that are going on. There's also this idea out there that a lot of folks that are selling into the U.S. market want access to the U.S. market, and so they're cutting some of their pricing, or they're at least reducing their margins a little bit, still making money, but making a little bit less, but they're still being able to sell to the U.S. Who knows? I think we still could possibly see some, but right now it looks like we might see some Fed rate cuts, especially if we get some jobs reports. We've got some more jobs reports before those announcements. If we see a continuing weakness in the economy, specifically with jobs, I think they're going to do, basically a maintenance cut. I don't think they're going to say that the economy is in free fall, but, the neutral rate has moved and we need to, move the Fed funds rate, the policy rate down accordingly to at least be neutral, where they're saying today that it's purposely restrictive. So they'll move out of restrictive territory to a neutral territory, not necessarily needing to be fully accommodative.
Yeah, no, I think that makes sense. I think that there's, even though I've spilled a lot of ink writing all these notes on investors are finally getting used to persistent elevated rates, I think we're in a restrictive element right now. And I think that there is no possibility that rates are going to go back to zero short of a world-altering pandemic or something like that. But come down to maybe 3 or 4 would help kind of.
I mean, the reality, again, we have the most insight into multifamily rents, and so I can't necessarily speak with certainty on every area of the economy. But I mean, we have seen we talked about this last week. We've seen a weaker multifamily leasing season, this year, and so when we're not seeing high growth rates, those high interest rates are absolutely restrictive, and they are more restrictive relative to where they were last year, because at least last year we had a little bit of higher growth rate. We had a not a normal leasing season, but we didn't see the fall off in May, June, and July that we saw this year, where we were expecting to see some really strong growth in May, June, July. Because what hasn't stopped some of that expense growth, is still there. There's expenses are higher year over year. Not as bad as it was. We're not seeing the huge insurance increases, but again, it's there's only a few assets in our portfolio where we've been able to significantly reduce expenses year over year. Everything is either kind of flat or elevated a little bit. And and I've heard this from different sponsors, investors across the board, this idea of NOI stagnation, net operating income stagnation, of where you're maybe getting some rent growth, but expense growth a lot of times due to uncontrollable things like insurance, like property taxes, is eating into that growth. And so when you look at an elevated interest rates, it doesn't help the situation at all.
I think that's probably the case, because I have read a couple things that have said, I think there was something in Yardi Matrix's last report actually that noted that expense growth was coming down, but when rent growth is below normal, you're not going to notice it as much.
Well, so, expense growth goes from 4% down to maybe a normal 2, or maybe it's still at 2.5. But if your rents are growing by only 1%,
then
it's tough. And rents are growing higher than that in many markets. I mean, they're growing higher than that in our portfolio. But again, property taxes go up by 30%. There's only so much you can appeal, but it takes time.
I did want to note too, and because I was thinking about this as you were talking, and I should have noted it even last year. Unemployment has been a persistent concern. That's something that we were tracking even last year during the Biden administration. It has been on this long trend downward. We used to really talk about, and it was true, there was a undersupply of labor, and now we're getting close to, it's kind of gradually decelerating, the drop in employment, but it's still, this is a longer term trend than just a couple of months. Even if we cut out the revisions and we just went with a kind of longer term trend that was going on from 2024, then unemployment could be kind of approaching a little bit scary levels somewhere in the future. But we're still, again, all things considered, unemployment is still well within levels of normal.
Yeah, 5% I think is typically viewed as like a healthy level of unemployment rate. We're still below that. I think we're at 4.2, 4.3 today. Something like that on a national level. I mean, the Great Recession, I think it peaked around, with 10%, 8, 9, 10%, I think. I mean, that's where it's like, okay, that's troublesome. We're so far away from that. But the trend is potentially concerning if it hits that, 5 handle and keeps on going. You have to ask, what's going on here?
Yeah. You did note the how much of a factor shelter was in inflation,
Yeah.
and we have the details down here, and I'll scroll down to shelter, and we can kind of see the breakdown, and maybe we can talk some smack about how CPI's measurement is not a completely current reflection of the market, but I think they're measuring something different.
I think they're measuring. We were having this conversation before the show, and I was like, we need to get Mr. Chapman, John Chapman on, who's our data science associate, to kind of help to try to explain in somewhat simple terms. And we've done it so many times on this show, and we've broken it down. But it's more that it obviously doesn't reflect the reality on the ground, but it's in real time. Mm-hmm. But it's being used to reflect the reality of inflation in real time on the ground.
Yeah, like
because it's a third. It's 35% of CPI.
Yeah, and there's talk and complaints of they don't measure home values; they measure owner's equivalent of primary residence, which is a survey that goes around and says if you were to rent your home, how much would you put it to rent? And that's what they use to measure home prices. They don't measure the home price themselves, partly because I guess there's like a capital investment aspect of home prices that they don't want to get involved in. They don't want to measure that. They just want to measure kind of housing as a service, and that's okay. But the question is that going to be useful? It's going to be useful to you as a realtor if you are, if you're a real estate agent and you're trying to sell your homes to get the CPI number, or do you go to like Case Shiller? So I think that this may be useful for some kind of government use where they figure out what people are renting and how much of an impact it is on their day-to-day life, and that's their measure of inflation. But for other people, for other uses, if you want to figure out what the market rents are, which is much more up to date and is much different from it's far ahead of what is in the CPI. If you want to measure market rents and you want to know when money changes hands, what the price of rent is, you should probably look to private sources. So it is measuring something different. I do think though that it is too flattening. That's kind of my issue. Is the CPI measures, it takes away the volatility almost like by design. It seems like, as some of the justifications that I've heard. I'm like, I kind of want that volatility to still be in there because it just I don't know.
Well, you can always strip things out, data. Right? I mean, that's why they have core and and there's super core as well, which strips out shelter as well.
Or do you want to go to the
wherever you want to go? All
right. So, you can see that core has gone up, and it's gone up a little bit. But I want to look here and just give some top line
3.1.
Some top line numbers about shelter. Shelter is up 3.7% compared to last year, and the rent of primary residence is up 3.5%, and then the owner's equivalent of rent, which is basically home prices, I guess, is up 4.1%. So right now we are at 3.5%. How much? That's elevated above the 3.1% up for all items. And I'm sorry, that's just core inflation. If all items inflation is 2.7, then that 3.5% for rents, that's going to push it up. But we know, based on market rent, that still has room to go down. The question is, and I even was asking this when rents initially popped up.
Well, an owner's equivalent of rent is 4.1, and it makes up 26%.
Yeah. So and I
well above the 2.7.
Yeah, housing is such a big skew, and I also think that owner's equivalent. There was an article in Forbes that I found that was arguing against owner's equivalent of rent because in the same way as apartment rents are lagging, owner's equivalent of rent it lags behind current home prices. And by like 6 months or so, they may get to an accurate price, but because these owners are not putting it on the market at the moment, they're just behind. And that information they're gathering from their survey when they're asking that question is 6 months, 9 months maybe behind current values, and that could mean, and I think it really does mean, that it's not capturing the softening in home prices right now.
And again, I don't think we have super core, but I mean, again, just stripping shelter out, inflation all of a sudden is like at target, closer to 2%. Mm-hmm. And so then again, why this is important beyond looking at what are the impacts of tariffs on the economy is what's going to happen with interest rates, what is the Fed funds rate going to be, and how that will impact longer term rates.
Yeah.
And the folks at the Fed, They're smart. Maybe they don't always make the right decisions, but they're aware of all of this. They know that inflation has cooled down significantly.
I think that that above all, you do illustrate the stakes of and the need for good, accurate information, because this is right in front of us what the government uses to make a lot of its decision. Now, again, you said Fed's smart people, but like these are the numbers that a lot of people, I'm sure that there are many government expenses that are tied specifically to the CPI.
That's true. Yeah,
and
a lot of things are tied to the CPI.
And so that means that like we better have a good assessment. And it kind of moves into this other topic of, well, is this going to get to are we going to get to the point where, not because of structural reasons, but because of maybe political reasons, that we can trust or not trust the BLS? Is every 4 years it going to be different? I'm a little bit unsure, and it just doesn't look good because also, aside from any politics thing, people aren't answering their surveys anymore. Did I reference how I want to make it mandatory that you fill out the surveys?
You told me, yeah.
Yeah, well, I wish they did, because people aren't filling out the surveys. They put out 60,000 individual, 120 business-related surveys, and I'm sure probably some of them are on the internet. But I bet a lot are in pencil and paper.
I better fill out the survey for the Ministry of Truth.
Yeah, and people aren't doing it though, and that's a big problem here and in other countries. And there are things that the surveys can capture that you can't get through other technological sources. They're working on different ones. I still think that that's a big problem. No matter what, that means that the data has gotten probably harder to gather, probably more expensive to gather, and so it's just going to get worse until they figure out something, which I think should be a law. You have to tell everything. You have to come up with hook your credit cards up to the government, and you have to fill out a form about what you spend and how much money you spend every day. And then we'll get some good economic information. Slight sacrifice to privacy, but.
Okay, Elizabeth Warren.
Yeah, sorry.
Okay, well, so Marcus Millichap has a piece, The Forces Driving Interest Rates Lower. Yeah. Is that worth talking about today, Matt? Have we covered that?
Yeah, it was a little. I just use it as a touchstone and Marcus and Millichap are using a very similar logic that we were using yesterday or last week, which was that, all right, low jobs numbers, is that going to push the Fed to lower interest rates? It's something that you were talking about too here. It's that kind of uncertainty has deadened the economic activity a little bit, and there's a balance and a trade-off, and it may lead to lower interest rates, but I still think that things haven't gotten that drastic enough.
Yeah.
There's some optimism here that Wall Street is pricing in an additional rate cut, but I think that it would involve a form of sanity that I have not yet seen in the Fed, unless they have an internal. So I think maybe we'll get a rate cut if there's an internal clock that they have in there, and they're like, all right, time's up.
So I mean, the probability now. I mean, I don't know when this video was made, but the probability now is that it's 85% for 2 rate cuts this year. I mean, so I mean, again, but we've just talked about it. The reality of inflation is lower than what the CPI is showing. If you look at Supercore, you strip shelter out, it's pretty clear that the neutral rate should be lower.
No, you're right.
It's highly restrictive, and you have a declining employment.
If inflation's going down, and employment's going down, then maybe interest rates go down.
The only reason to keep really rates high, other than to maybe seem not political, is that if you think that, no, we really need to reset this entire economy, we need to push it into a recession, and just to do a hard reset and flush all these assets. I think that's pretty hardcore, and that's not something that that probably is the right answer right there.
Yeah.
But no one has the stomach for that. I mean, look at what has been going on in commercial real estate. We can't even have, developers and owners who have been speculating lose any money because, maybe it'll affect the banks and it'll downstream effects. But we're in a world where no one wants to experience any loss. We don't want to go through a recession. Everyone should just be fine, and everyone gets bailed out, and we can kick the can down the road. So in that type of world, I don't see them pushing it over the edge. I think the only reason why they haven't lowered rates is because of tariffs and Trump talking about firing Jerome Powell and they need to lower interest rates. And so they want to come off more independent, which then now makes them seem more political.
Yeah.
And it's invited politics, but there's going to be new Fed board members coming on that Trump's going to nominate that are most likely going to be more dovish. We may be looking at a new chair of the FOMC that sounds like they're going to be more dovish. So, which again, with all it's all interesting because again, tariffs and dovish Fed policy is like a more of like a left political liberal stance, and it's being done by Republicans, which I think is fascinating.
BLS has has a new commissioner, and
do they finally again?
They have replaced it with a
commissioner. They replaced it. Then we fired the IRS commissioner. It's hard to keep track,
but they do have a new BLS commissioner. And so the BLS commissioner is going to be consistently reporting lower inflation. Great. Fed's going to read those reports. The Fed's going to be now full of politically, or just ideologically motivated.
Matt, are you
to have lower interest
suggesting
rates.
that
I think we're going to get these lower interest rates are going to come in spades.
Are you suggesting that this CPI report had political influence? Is that what you're suggesting?
Oh, that's a good point. It depends on how long he's been in his. I think the chair.
Let me see those numbers.
It's not even warm yet.
Who's got the model? Who's got?
Yeah.
Click.
And that's a really good point. That like 60,000, 100. There's a lot of people that this passes through that probably is going to make it very hard to skew the numbers. But I look forward to these deviations. Won't probably track it, but
well, what I'm looking forward to is looking back on the whatever New York Times, Washington Post, LA Times articles of being of saying the BLS is infallible. It can't be corrupted. It's just statisticians and professionals. And then the articles are saying, can we really trust the BLS and their numbers?
Oh, yeah. And it's coming. And that's sad, too, because what I was trying to kind of communicate last week is and it's probably naive of me, but I think there should be a government objective.
Ministry of Truth.
Ministry of Truth. Call it that. That's fine. There should be a thing that's separate from kind of corporate bias that they use. This is what we're using. These are the data sources that we're using. Transparent, and I don't think that it really exists. I think
you can create that institution on your own.
Yeah.
Anyone can create that institution and have not corporate bias, make it a nonprofit, and do their thing. Because we're obviously talking about political bias in this context. Yeah, it's fine. It's all it's a data point. And my big thing again, because there's argument about unemployment rate for decades. It's like that unemployment rate's not real. Same thing with inflation. I mean, back in between great financial crisis and the pandemic, when we had very low inflation, there were a lot of people saying, no, the real rate of inflation is actually 10%. Because in the mindset, and I'm all about real assets, hard money, that end of the spectrum. But it's like we're printing all this money. No one could figure out or believe that we could be printing so much money and not creating inflation. Well, there were reasons for that. The velocity of money was down. We had all this impact from technology that's a massive deflationary effect. But it seemed like, well, you print money, that means they're going to cause inflation.
Yeah.
But no one was wanting to believe the inflation numbers. And there were all these alternative inflation numbers of showing inflation between 5 and 10%. And that wasn't really the case. Same thing with unemployment. The way that they measure unemployment, if you're dropping out looking for a job, you're dropped out from the rolls. You need to look at not the U4, but you need to look at the U5 rates. And the reality is, it's like, let's just be consistent with what we're looking at. If we're looking at the same numbers calculated in the same way, there's at least a benchmark we can reference. We can say that those numbers, the way they're calculated, are complete BS, but at least we're being consistent. And I think with CPI, the same goes, that at least we're being somewhat consistent with what we're using. Yeah. But we can also step back and say, is what we're using accurate and useful for the objectives of determining monetary policy?
It is. Even when you were like, well, I can't even explain. I was like, you're right. I can't. Even trying to explain how they use the data they're gathering for housing, it's still like, as I think about it, it's like, well, that does seem a little impractical, a little weird, but philosophically, maybe they find some use for it. But I'd rather just know how much a home is worth, rather than saying, all right, to calculate your home value, I'm going to have you pretend that you're a landlord. Now you're going to issue rent, and then it's like, why can't you?
Well, I go through that exercise.
Yeah.
It's wild.
Yeah.
Okay, man.
Oh, I did one thing about the jobs numbers. I looked at ADP ADP versus the BLS numbers. ADP, I don't know if they do revisions, but it's very similar. They actually had a net job loss last month, and it's come up this month, but it's following similar trends after the revision. So either ADP got it right, or I just think the lag in the BLS numbers, having to do those revisions, is kind of interesting.
So if you have Ministry of Truth, then all of a sudden it's going to be illegal to have it your own numbers because they're going to be one set of data.
Yes. Oh, I look forward to that. You don't even have to think anymore.
What dystopian world do you want to live in, man?
I know. And you know what? We do gather all. You're right. Like when we're gathering our data, we get it. If we're looking at rent growth, we look happily at apartment lists, Yardi Matrix, RealPage, CoStar, and the same thing for any other assessment, things like cap rates or even like investor interest or something like that, investment sales and stuff. We're always combining and measuring things against each other, and you look for general trends across all of them. And I don't think that one single data source is useful in that way. So you're right.
There we go. A little bit of competition doesn't hurt. Okay, now we're moving on. Speaking of competition, Fannie and Freddie, they've been monopolizing the multifamily mortgages, not to mention residential mortgages. I mean, if you're getting a conventional mortgage, it's coming from Fannie, Freddie, the agencies. About half of multifamily mortgages are issued by Fannie or Freddie themselves. A lot of talk about privatizing, but now specific talks about an IPO later in 2025. Man, the big thing about Fannie and Freddie, they come with a government guarantee that allows the risk on those mortgages to be a little bit less. So big investors will buy pools of them once they're securitized by the agencies. Look, it's got a government-backed guarantee.
Yeah.
I'm willing to take a little bit of a lower rate. That allows borrowers to get a little bit of a lower rate, a little better amortization period. For example, a multifamily, agency loan, you can get 30 years, up to 35 years of amortization, which is like your payments are stretched out, and a lower rate versus your conventional commercial lending, which is typically amortized over 25 years and often has a higher rate.
Yeah.
And usually, not always, but features a floating rate versus the agencies will offer either a fixed rate or floating rate. So really good terms. That's why they've been able to get so much market share, and it's kind of the go-to for buying a stabilized asset.
Yeah.
A lot of uncertainty around this idea of an IPO for Fannie and Freddie. So a lot of it's just we don't know exactly what that world looks like. Post receivership, they're government-sponsored entities that really went bust back in the Great Financial Crisis, and we don't know what it looks like. Do the guarantees stay? Is that better for the market? Multifamily. I've always multifamily investment's a good deal. Do you need to be subsidized? But on the other hand, we have a housing crisis. Yeah. How does the government incentivize the purchases of real estate, residential real estate, and the investment into residential real estate?
Yeah.
If they're not going to do it through interest rates, is it going to come through another subsidy, like more tax credits? So what's the lowdown, Matt? You've been reading into this. I think there's a lot of uncertainty.
You hit on what I think is the most interesting thing about this. And also the most important thing I think are those implicit guarantees. But the most interesting, or at least maybe meaningful, is that Fannie Mae and Freddie Mac were part of their mission, right? Was to, or at least part of the government's involvement was to make housing cheaper. Or so if. And I could be.
Or borrowing cheaper.
Yeah, or borrowing cheaper.
Provide access.
Yeah, there were, but that was kind of the service that they provided, at least. So if they want to continue providing that service and making borrowing cheaper, then government will continue to be involved. But if they move farther from that and the government wants to cut their ties, that may mean that rates go up because the implicit guarantee is gone. I think so much revolves around this, not explicit at all. The implicit guarantee, which isn't put in law, there's no law that's up there that says Fannie Mae and Freddie Mac will always be bailed out. There's a big proof point in 2008 when they were rescued and put into receivership, or they were really very close to the government. My question is the IPO, in order to maintain that guarantee, are they going to have all the baggage that they have right now? Like, if IPO frees them from regulation, well, if they have the guarantee, is that going to put those regulations right back in? Because in order to have that guarantee, you want all these strings attached.
Yeah, you would think so. I mean, like for example, there's for certain loans to get certain terms, there's green requirements. You can get a better interest rate if there's an affordability component, which means that your average rents fall within a range of area median income. And so you can, essentially, enact policy through the agencies. I think that, the Biden administration was going to clamp down on certain things, use more of a stick approach than a carrot approach on whether it's, junk fees or whatever, they called it. So there was that ability to be able to impact policy through the agencies because the government's saying, look, we're going to provide this guarantee. That's going to come with some terms.
Yeah.
There's nothing I guess that's illegal from saying the government saying, look, we're going to continue to guarantee these securitized loan pools.
And that's been, Trump
do
has
X, Y, and
emphasized
Z.
that. He's like, we want to keep these guarantees. We want to keep that in place.
But then I guess, coming back to competition, from the guy that wants to get rid of the post office because we don't need the post office, why do we need these government-sponsored entities making loans?
Yeah, I think it goes back to the mission. But
isn't that picking winners and like we're picking these two winners of like these are going to be these now so sort of more private companies. Yeah. They're the ones to go to. Like how can a mortgage provider compete?
Yeah. Oh yeah, if you're a mortgage provider, but
or a bank, a lender, a lender.
I think that Trump came up and knows exactly where he stands, and he likes cheaper loans from Fannie and Freddie and likes that guarantee and knows the value of that low risk that kind of passed on to the borrowers.
I mean, I do understand, and then I guess the only thing I've thought of, thinking about this problem is I've thought about it a lot because I really don't like the preference given to Fannie and Freddie because their organizations, they're full of people who are infallible and
okay, all right.
No, they make a lot of mistakes.
Yeah.
I mean, there has also been, talent drain about those organizations because there's been uncertainty. Yeah. So I don't know, the people that are running those organizations may not even be the most talented.
Yeah.
Except at Freddie, you guys are great right now. But at Fannie, I can't say the same for. And the only solution is being able this guarantee to not be exclusive to Fannie and Freddie. Is as long as you originate a mortgage and it meets certain criteria, the government provides that guarantee for that type of securitization pool.
And
there can be other companies that can securitize loans that can apply for that guarantee. Yeah. And it's not just a duopoly of Fannie and Freddie, which there's talk about even combining them or something into one thing.
Kind of the IPO maybe makes sense.
Then it's just like that's a company, but everyone else has this access to this guarantee, so it's a more equal playing field. So you can have competition. You don't have the two biggest players be inept.
Yeah. That's a good point. I wonder, that's a good wish, and I think fairly sound if you make these things, or are they? Because it's like if they're inept in Fannie. Maybe they're not inept in another bank. Why are you?
That's what I'm saying. The organizations that are incapable of operating like a normal business, they should fail. And a organization that provides better service, more value to their customers, which are the borrowers, and then also the bondholders. Those are the ones that should be successful. And these two just behemoth organizations that have been around a long time because they've got the blessing of the king shouldn't just be the only two names in town for financing just because they've been around and they've got these guarantees.
To me, like you put the IPO out, their real selling point is that it are the guarantees, and so I don't think that
the reason why they want to do it is they want to raise a bunch of money.
Yeah,
they're looking at they're trying to get looking for $3 trillion in revenue and looking for $3 trillion in savings.
Okay. The government,
and, the government. And so if they can get some revenue by selling Fannie and Freddie, they're like, look, we tried the public lands. They didn't let us sell the public lands.
Yeah.
Well, do they really care if we sell Fannie and Freddie? They're trying to make some cash, which again, from a business, if you think about a business, not a bad idea. Look at your balance sheet, look at your assets, and like, do we really need to be in this business? Let's sell it off.
They're not selling all of it either. Supposedly they're selling
going to keep a piece.
5 to 15% in the IPO of the full shares or something like that. But $30 billion of it.
I just, again, I just don't love the idea that I love I love multifamily, but I've never liked the idea of having, essentially the government being your partner in the deal.
Yeah.
Whether it's HUD, Fannie, or Freddie. I get it. We want to incentivize housing. But then when you partner with the government, the inefficiencies can be insane, and there's no repercussions. If Fed wants to just like not answer the phone, there's nothing you can do. And you're like, where is the file on whose desk is the file sitting on? And they're like, that person left. It's moved. The piles have been moved around.
You can't get them fired because they've already quit.
They've already quit. Yeah, they got their incentive. They got their email from Musk, a couple weeks, months ago, and they decided to leave.
It'll be interesting to see how this progresses. Again, like I said, it's like I'm just ambivalent about it. I wonder what the benefit for borrowers is going to be, and I just don't see them ditching their selling point of having that close connection and with the guarantees and all the baggage that it entails. But who knows?
I think they should just let other people. If the loan pool qualifies, anyone should be able to securitize and put it together.
Yeah, and maybe they have other filters for institutions, like the institutions must meet these criteria, or the banks. If you want to act like another Fannie, you've got to have this much money, or have these rules or whatever.
I mean, the way they're doing it now, I mean, you can be like an originator for Fannie or Freddie. We can originate. Fannie has like DUS lenders, direct underwriting and servicers. And then you can originate for Freddie. I mean, it's not like there aren't other organizations that are involved in the process, but then it's got to go up to Fannie and Freddie. And they pull it all together, and you've seen their headquarters. It's big. I don't know what they're doing. They don't need that money.
I saw some shots early though. Where was it? The HUD,
Washington D.C.
Or there in one of the buildings of Fannie, or maybe it was HUD, that had like leaky roofs or something, and I thought that was unfair because they probably weren't.
Probably HUD.
Yeah, it could be. But yeah, we'll see.
They're sending us. There's the reports that they're sending us to fix. We're fixing them.
Yeah,
but they probably get extensions on their.
Yeah. That's right.
They probably get all kinds of extensions on their. Their lender repair reports.
Pretty sweet loan on their office. That's funny. All right. I think that this does connect with this next article. I wanted to loop the next few articles together. A couple short articles from Credit IQ and TREP collectively showing how distress, at least the measure of distress that is shown here in the Credit IQ article, is going up. This is a really interesting development because I kind of was starting to think and starting to have my doubts that I was wrong and maybe low maturities are never going to ever be a problem. Maybe people will wriggle out. I referenced last week this really great report from TREP called on an issue they describe as loan maturity drag, and how without really paying the price and without necessarily extending and pretending, lenders and borrowers are like sitting it out for a while and letting loans just kind of still be there long past their maturity date.
I mean, just not even extending it, just being like we're gonna just not say anything, just keep paying us.
Yeah, it seemed like that. Like there just seems
nothing's due.
A number of different ways that they are delaying. Call it extend and pretend.
Yeah,
it's not going
away.
It's
the same. Just keep the
essential
can down
things
the road.
Is like these problems are not being resolved. They may be extended, they may be dragged, but they're not getting solved in any meaningful way. And I like this chart too because it shows that we've essentially doubled where we were 18 months ago. So February 2024, the loan maturities were about. Now this is the loan maturities that are delinquent. They were 5.4%, and now we are at 11. I'm sorry, I'm looking here. No, we're at 8.6%. I'm sorry. So it's a little less than doubled, but still a really strong increase in those maturities. And what's also interesting is how it used to last month there was a decrease, and now it's popped back up again. I would argue that from basically March until now, it is the number of loans that were either delinquent or special servicing have gradually increased. That's like the long-term trend is delinquencies are increasing after dropping earlier in this year. So that's 3 data points, 3 points of increases, 3 months of increases in delinquencies or in distress, however they manage it or however they call it at Credit IQ. That is a little bit of a trend. I still think that it's a bumpy road of a trend, so we could see it decrease, It's not looking like it is, though. From the past 3 months of data, looks like this problem is going to persist, and it is not going down.
I mean, it makes sense. Again, everything we've talked about. I mean, interest rates are still high. If you're on floating rate, I mean, CMBS, that's conduit lending. So we're not talking about CDO or CLO pools. We're not talking about necessarily agency loans, but it's a good snapshot, and it's going to be kind of relevant throughout. They're not. Where's the recovery coming from? The rates aren't low enough to get to refinance.
Exactly.
You're not able to grow out of it. We talked about NOI stagnation. Even if you have rent growth, which most markets don't have rent growth, a lot of deals have negative NOI growth. So they're even further away from being able to sell or refinance. And unless, again, we've talked about it. Rates need to go down significantly. Rent growth needs to come up significantly, or expenses have to come down significantly. All these things have to happen, and none of those things have happened. So, I mean, with no evidence of true relief, I mean, there's a hope now.
You sit with the banker and you say, the hope you've lied.
Now that's the thing. Now that there's even more hope, is like, well, no, we're looking at rate cuts. There's going to be 2 rate cuts, and maybe there will be, but maybe 50 basis points. That's not enough to really move the needle. That doesn't turn a deal that has a DSCR below 1 to a 120. I mean, maybe you'll barely be able to cover debt service.
And you've been telling me this for the past 2 years. That relief is around the corner.
Exactly. But now again, it comes back to the lenders don't want to. It's kind of everyone's problem. All the downstream effects. The bondholders don't want to realize losses. The lenders don't want to realize losses, or they don't want to deal. They don't want to deal with it. And no one wants to experience pain, especially if they're their customers, essentially, that are going to be experiencing that pain. They want to keep doing business with these people. Some of these guys have made a lot of money over the last couple of years. Some of them are still buying real estate. And so they don't want to, start foreclosure proceedings. Now, people have been foreclosed upon.
So this is just some data from TREP that shows that things are a little shaky. This did not have as high of it didn't show a unambiguous increase in the special servicing or anything like that. I just wanted to corroborate this and show that actually we're looking at around 8 percentage points for the special servicing rate in from TREP. That's just overall, and then compare that with, we're looking at the specialist servicing rate is a little elevated when you look at Credit IQ's numbers. That's a little under 10.5, so like 10.3%.
Did they have number on? Was there any default?
No, I'm not
sure. On an actual any default numbers.
So there is additional data, and if you want to move forward, I would really love, because I'm excited about this one. State of the U.S. capital markets, and I really want to drill on, drill out, whatever.
Drill through. Drill down.
Drill down. That's where we drill. The lending section. So like page 20 is, I want to skip right to it because it gets to the point of how much and who is experiencing these loan maturities and may have distress that's building. They have counted $41.6 billion in insolvent multifamily debt among loans set to mature before 2027. That number is very big. It is the biggest of any sector. In terms of the proportion. Now, in terms of raw numbers, there may be a slight difference, but no, actually, it's even in raw numbers. In raw numbers and in percentage. So it's 55% of outsized securitized CRE debt maturing before 2027. 55% of that is insolvent, as compared to this is ones where the DSCR is under 1. So they are not taking in income enough to pay their loans, right? And that means they either draw on reserves or they make a capital call or something else. But that's a lot. 55%, $41.6 billion.
Now, that's not the whole multifamily market. This is just loans that are maturing before 2027. So these are deals that have loan maturities that are coming up in the next 2 years. Not necessarily, I don't know if that also probably, depending on what this pool is, includes loans that have been extended. If they're looking at the CLOs, the bridge loans. Again, I'm not exactly sure. That just says DSCR profile of outstanding securitized CRE debt maturing. So it does say in the top, floating rate loans on even property types with strong operating fundamentals could face challenges covering new higher interest costs. Floating rate loans on transitional product, significant portion originated by debt funds and securitized and CRE, CLO are particularly fraught. So they are including some of the CLO stuff as well, which makes sense. That's rough. I mean, low cap rates.
It's a snapshot of
low growth.
Even though it's just talking about this small segment of loans that are maturing before 2027, if that's at all representative of other loans, which maybe it's not, but man, 55% can't pay their loans. They have to draw on extra money rather than income. That's a big deal, and that's something that I don't know. I think it's kind of gone out of the discussion a little bit. I think it probably has gone out of the discussion because of what you said before. Like maybe banks are really motivated to not deal with it in the way that we think.
Clearly.
I wonder how long they can really endure this though if they're not getting their rent money. The banks aren't getting their rent money. The apartment owners are not getting their rent money, and the banks aren't getting their interest money. And are we just going to give everyone a pass and just wait until 2026? Because that's what I was thinking before. Is like, are these apartment owners sitting down with the banker and talking about, which we've got a Real Page article here about it, about the undersupply that they're going to see in 2026. Things will really pick up next year. I think that's a story that the bankers have heard a lot. Like it's always going to be brighter next year. And
everybody, you want to believe it. I mean, and all those stories make sense, and it's just a question of when, really. I mean, like the supply has been receding. When are we going to see more stabilization? I mean, the data pointing towards it should be relatively soon. Mm-hmm. But again, the market's still quite choppy. And again, so again, like you said, these aren't necessarily loans that are absolutely going to fail. Mm-hmm. When someone can keep putting money into it, they can bring on pref. There's a lot of ways to work around this, but that's 55%. That's a lot, especially compared to office, which is only 25%.
Wait, so but DSCR under 1, is that what negative leverage is?
No.
Okay.
I mean, you would be negatively levered, but negative leverage is when you take on you buy a deal that is the cap rate, the capitalization rate, or you kind of think about like kind of your yield is less than your interest rate. So the money that the property is putting off.
Oh, so like a cash flow.
Yeah, but your debt isn't on. You're not 100% financing. So if you're 100% financing, it certainly wouldn't work because it's like the property is throwing off $2,000, but your interest payment is $2,500. Yeah, the math doesn't really work. But typically you're only borrowing. If you're only borrowing 50%, well, that's a significantly lower, mortgage payment. You might have the cash flow to still cover it, and so you can have a DSCR that's still above 1. But you could still be somewhat negatively levered relative to your. It's an interest rate and cap rate relationship.
Okay. I thought part of it may have been factoring in appreciation too, as like.
It really comes down to like how accretive is the debt and how effective it is. On the overall deal.
You did talk about buying, and I wanted to use that as an excuse to shift into some of the stuff about how debt origination, actually things are picking up. I think that at least, in my optimistic view, this is probably a sign that people are getting more interested in re-entering in buying and selling real estate and being investors again after a very sleepy 2024. It looks like we're up by about 49%. That's how much debt origination has increased. And I was also looking at this portion. So we have here at the bottom the origination for the sales, and that's 63. And I don't know, what are these in millions? Yes, in billions. I'm sorry, billions. 63 billion was spent in 63 billion of sales. Loans, and then compared last year to 47 billion. Looks like a huge portion, 253 billion in refinancing. That's a huge happened this year compared to 165 last year. What I'm really looking at though is construction loans. 364 this year, 364 billion. This is year to date compared to 244 billion last year. It seems like a big jump, about a 50% jump since last year, construction loans, so maybe we're building more, but we're still building less than like pre-pandemic. Pre-pandemic, we were 579, 5 and 6 billion, so we're like 40% below normal in terms of the construction loan originations. I'm using that as a little bit of a proxy for maybe we're not building enough still. And that's this article I'm still going to keep
Well,
teasing.
we had that spike in permits, two months ago that kind of lit a little bit of head scratcher. I mean, I think what people are seeing is, look, there's going to be positive growth fundamentals. Supply has receded, even at that 364 billion in new construction loans. That's way below, the previous average and the trend. And so we're going to be into a low supply environment, I want to be delivering in that environment where there's some positive rent growth. I think that's where a lot of investors are getting in the market right now because they're seeing light at the end of the tunnel. They don't exactly know how far away it is, but they're starting to see it.
I think so.
And they're wanting to get in now. I mean, it's what we talked about the kind of the lead up to the show last week. Are people, you're either waiting for it to get much cheaper because you see that 55% of insolvent loans. It's got to be cheaper, or you're in the camp of saying it's already gotten cheap.
Yeah.
And even those deals that are insolvent, they could still transact at the 15 to 25% discount that where multifamily prices have come down to, and maybe they can just get their money back, perhaps, and move on. And it doesn't necessarily mean the prices need to come down significantly more, especially when there's investor interest. And then we actually start to see interest rates reducing, which I think everyone's in. I'll believe it when I see it, except the lenders who think at some point it's going to happen. For sure, it needs to.
Yeah, I'm glad you brought that up, because these are the numbers behind this very phenomenon. Sales. This is commercial debt real estate origination. I'm using this as a proxy of sales, but 43% since last year, and compared to the pre-pandemic average.
But a lot of that's refinances, right?
Yeah, that's a good point. So this could be refinancing and not sales, but we can look back up and see the proportion.
Look, it's mostly refinance. It's 44% refinance versus, big drop to, 34% increased sales year over year, but 53% increase year over year on refinances.
And I'm wondering if they are using, if they're adjusting for inflation when they're coming up with these averages. But
not. I don't think so.
There's a little more loan activity, at least. I was trying to say, but there is some slightly more sales activity as represented. Things are picking up a little bit,
we knew that, man. We had reports on loan maturities. These loans have been maturing and people have been refinancing. Yeah. Now, that doesn't mean that they're out of the woods permanently, because a lot of these refinances have required preferred equity. So a lot of folks bring on preferred equity to bridge that gap. That equity gap, because they are having to do cash-in refinances, which means that their common equity is getting, not in every case, but in often case, they're getting smoked. Common equity is getting diluted in a big way, if not just completely shoved down and crammed down to nothing. Yeah. And pref equity is coming in and saying, we're going to lock in, a 11 to 13% return, and if things go wrong, we're going to take over the deal. Well,
that's an interesting thing that you mentioned, because I wonder if investors are thinking about that, are thinking about their position in light of possible things that the syndicators or that sponsors may do, and thinking, all right, I can't invest right now. I don't have money to invest. And that's in Newmark actually argued that that's part of the reason why there's a little bit less dry powder around compared to previous years. It's a little bit off from the peak, but it's still very, very high. But it could be people are like, I can't get into this. I still have to work through this problem and got to make sure that maybe I get paid back for an investment that I made.
Yeah. We've been having conversations with investors, current and prospective, limited partners of ours, and a lot of them have. We mentioned this. In the past, we've mentioned so many of them have gone through capital calls. A lot of them are still looking to invest. They're reaching out to us because they're like, you guys are the only ones that are still in business, or you guys are the only ones distributing. I invested in 10 syndications. You guys were one of them or two of them. You guys are the only ones that are still distributing your deals or operating. You guys are the only ones communicating with me oftentimes also. But then they're like, I'm ready to do the next deal. Yeah. Some of them are. I wouldn't blame some to say, I've just been burned. Yeah. I just have a bad taste in my mouth, this whole real estate investing thing. Syndications, I don't like it. I can't blame somebody who's gone through multiple losses and lost a ton of money.
It injects like realistic risk into the market. Like if a certain percentage of investors our investors' money are locked up in deals where they don't know where to go, then then there is a reason why they're not going to have as much sales.
There was a long period, post GFC of where it's like these multifamily deals, unless you really mess something up, like none of them were like failing. Maybe you didn't get as good of a return. And there was always an idea, especially like when I was really getting into this in like 2015. I mean, the GFC wasn't that long ago. And so like it was still relevant. It was a little bit longer ago than like the pandemic is relative to us. So it was like still fresh. There was still the idea, it's like, well, you could get wiped out, but no one was getting wiped out. And it was like that for many, many years. It was like, it's possible. Of course, there's a possibility of losing your money, but like in this environment, that's not really happening at all. Whereas we're in an environment where a lot of people have lost a lot of money, which that's the reality. That's investing.
It will be interesting because it seems like the way it would go is if there's a lot of distress from CRE debt, then why wouldn't there be similar problems in single family homes? But like, what if there is a
30 year,
what if there is a crisis that is more limited to like apartment? These are because apartment distress has gone up considerably, and there's something there that it's not present in single family homes. This has not been seen before.
The difference between multifamily and single family homes is, these single family homes were bought at 3% rates, and they're locked in for 30 years. Whereas we're talking a lot of these multifamily deals were bought with floating rate, and the term was 2 to 5 years.
Yeah, this will be. I'm gonna have to look in to see how this compares with the pandemic in terms of like how much of a cliff is approaching here versus then when things went south, and it does seem like things are more robust now than they were then, but you can't argue with nearly $1 trillion of outstanding CRE debt. That's potentially
but in the pandemic, interest rates were zero. Money was free. So there was, not just what the interest rates were free. I mean, the government was literally helicopter moneying everywhere. Don't forget the stimulus checks, the PPP. There was money coming from everywhere. So renters had money. I mean, we had communities where our residents had more money in their pockets than they ever had in their life. Our delinquency rates went to 0. And so it's just a different environment. Now, if you fix your rate in that time, you lock in those low rates like we did on a lot of our deals, it really doesn't matter what's happened with rates since then. You were able to weather these storms of rents going up and then down and expenses going up because your cost of debt is fixed to a point of where it's just not impacting the overall deal. But a lot of these properties, again, if you have a floating rate debt or a shorter term maturity, are running into some of those problems right now.
Yeah, I agree. This is a little bit of a jag, but I wanted to. There's only one more thing I wanted to talk about this in this report, because I really think that the most interesting part of this new market report was all the different angles that we got on loan maturities and CRE debt and those kind of things. They have isolated. I guess they've done this since 2016. They have isolated the geographic center of institutional capital in real estate. So it has moved. Let's see. Since 2016, the average longitude and latitude weighted by transaction volume for institution. So where are all these deals being done, and where in the U.S. is it on average? And on average, it's it's a little bit around Oklahoma. I think it's in Arkansas right now.
Is this an example of like why averages aren't always like don't work?
It's like if you were to invest, be an institutional investor, I don't think people are flocking to the northwest corner of Arkansas.
Oh my gosh!
But this is a funny average that shows what it does show. At least is like they said. U.S. institutional capital has favored the South and East more. It's
funny. Isn't that where Rogers, Arkansas is? That's a very popular investment market right now.
Well, maybe they're. Wow. Okay, so that's going to weight. It's going to draw it towards that center.
I guess.
But it's interesting as a illustration of a trend. So there are more people are investing in maybe Miami versus Atlanta, maybe, or definitely Miami versus Boston.
I think. Think about the north. Think about the northern markets. The South, obviously, the Sun Belt's been a trend, but what are the northern markets that are really drawing weight? Now there may be some. New York City, obviously. Boston, gateway markets, Seattle, Portland, those are those northern markets that, would carry a lot of, I guess, Philadelphia, Pittsburgh.
Because it's moving east and south. So I'm thinking about how actually, in the past 5 years.
Less investment in California.
Yeah, like San Francisco, this is just for multifamily. San Francisco, Portland, Seattle, all those kind of Pacific Northwest, they weren't doing great in terms of
you just think,
growth.
how many times you heard Texas, Florida, Texas, Florida, Texas, Florida.
Yeah.
That's been a standard playbook. Now, I think there's probably more investment going on now in New York and Boston because some of those markets are seeing some decent growth. I think some investment's probably going to return to California because I think some of those markets are kind of reset. I mean, San Francisco, we talked about last week. Yeah. Leader in rent growth. Finally, it's coming back after years of declines.
Has anything, a bunch of AI jobs coming in there?
Yeah, I think so. Yeah.
It's interesting, and I think it all comes back to supply. I think that some of the places where they built a lot, that's where there wasn't a lot of rent growth. I think there was a huge supply glut in Phoenix, but actually I'll take it back. That was too much. I was too much of a stretch of a transition. I was trying to transition into lower construction volumes for apartments, but what I do want to say
we don't need to give everyone all the information.
I know, but I just thought of this. It's funny.
Inside baseball of our transitions.
I think that institutional capital is going to go south and east, no matter if there's a million apartments being built there. I just think there is a momentum of investor interest that makes places in Tampa, even though they may have a lot of apartments, just makes it such an attractive place to invest. And the story of the South is so powerful. The
demographics are really strong, and there's going to be continued investment in the Sun Belt without a doubt. But I do think that there are a lot of other investors that are exploring other geographies because they're so overweight. Those Sun Belt markets. And they're not out of the woods. They still have zero rent growth to negative rent growth. So it's very difficult to underwrite. And so if you have dry powder capital to deploy, you need to find markets that have some growth that you can actually underwrite. So that's where I've had multiple conversations with investors this week. Had one today, investor from the Sun, actually very active developer, doing a lot of, not multifamily, but a lot of real estate. And they're looking for some geographic diversification. They're like, the markets that we're in they're oversaturated right now. They're like, the growth is there, the jobs are there, the people are coming in, but we've just built so much right now. I'd like to get in some markets that aren't getting that much attention, but still have some high growth rates. So I think there's some diversification going on, and that's kind of our head. I mean, that's what we do at Great Capital. We kind of provide that hedge. And getting into some of these markets that have a high growth rate, but still are relatively moderate on their supply or lower supply.
Yeah, it just seems it's surprising maybe, and maybe institutions should be looking a little bit more north than they are looking, but it does make sense in the sense that like institutions may be slower moving. Although I think that if there's a bunch of people in these institutions, they're smart people, they're making very quick moves sometimes, buying up billions of dollars of property some places. Why can't they look up north? For that?
I mean, they are. They're just less than they used to a couple decades ago. And as you said, the narrative and the story is so strong. The demographics are so strong. Those demographics don't always translate to rent growth. But I think that there's a nuanced conversation happening just because it's being forced upon, because these theses, investment theses, are being examined because they didn't all work out the way that they were pitched.
Well, and if you're working at an institution and you've gone through all these deals and you've been like, no, not another one in the Midwest. No, and maybe you don't want to seem like you're wrong. I think that there's probably
doubling down on your convictions.
Self-important institutional investors.
Oh yeah, we weren't wrong. We weren't wrong on the thesis. We just need more time to execute There's definitely some of that doubling down. And again, if that's where your base of operations is, if those are the markets that you're invested in, you kind of don't have a lot of too many options. You can't necessarily say, hey, we're going to move to the Midwest. Now, some developers are, they'll develop wherever.
And things are changing so quickly. Especially when it comes like supply. And like they're saying that this is the paragraph that I'm thinking of. Austin is the apartment market that has seen the steepest drop off in construction activity in the past year. So maybe you are overweighted in Austin and the thesis doesn't work. Well, it may be starting to make sense very quickly because things are coming into balance. I'll admit, quicker in these oversupplied markets like Phoenix, Atlanta, Dallas. I thought that their supply would kind of wane because they got more to work through, but it looks like it's coming off really quickly. And nationally too, we're building less apartments. We're building fewer apartments than we were 10 years ago, which is a really interesting number. They've, I think that the apartments under construction right now, again, this is what their headline number is. Apartments under construction are lower than they've been in a decade, a 37% decrease from a year ago, and I think that they have even farther to fall. This is based on long-term trends and permitting. Now, there was a spike up in permitting a couple months ago, maybe, but it like the long-term trend is definitely declining permits, declining starts. Where does that lead us to? It's got to lead us to declining construction activity, because I think we've also worked through. There was a backlog of apartment projects. I think we're done with that now. I think we've got enough. There's no there is no tanker that is caught in the middle of the straits or something. Like, I think that we're done with any of that kind of supply chain bottlenecks. We can build as quick as we want, and we're building fewer because of high interest rates. That's the most important thing. Is it's not demand driven. It's really like interest rate driven. Drawdown in construction that could mean that the supply demand, it comes into balance, and maybe rent growth comes back to more typical levels in the future. So that's kind of the situation that I'm gaming out, and that's what maybe the troubled borrower is talking to their banker about and saying, listen, look at the declining construction value. We're going to be okay. Give me an extension on this loan. I think that's a shakier conversation to have. I think the better conversation is, hey, how can I invest? How can I invest in apartments because of this improving construction outlook? And
well, one way you can do that is, if you're an accredited investor, is hop on over to graycapitalllc.com. Learn about our latest investment opportunity, Flats at Stones Crossing. It's a Class A 2024 development, 292 units in a fast-growing submarket of suburban Indianapolis in Greenwood. Love the deal. GP is making over a $3 million co-investment into the project itself. So we're putting our own money in the deal. We may be the largest investor. We're raising a lot of money, $25 million. So we may have a couple investors that write some big checks. But the investment minimum is, I say, only $100,000, but $25 million is a lot. So we got to kind of start picking up the pace at some point. Yeah. If you're looking to make an allocation, whether you're a first-time investor or you've been a long-time listener of the podcast and you're just curious, we'd love to have a conversation with you, see if it's a good fit. Again, it's only open to accredited investors. That's because of the SEC. I don't make the rules. The SEC makes the rules. Damn the SEC. But we'd love to have a conversation with you. Again, see if it's a right fit. Go over the deal documents. But again, hop on over to graycapitalllc.com. Even if you don't want to speak to us, you can watch the full deal preview video, get access to due diligence documents, all kinds of useful information to learn about our process, the deal itself, and let's partner up and acquire an incredible, high-quality multifamily asset in the growing Midwest, which is in our backyard. We're in Indianapolis. It's just that way. Hope to talk to you soon. Thanks for watching this episode of The Gray Report.